Hi, this is Ron Rowland for Money Markets TV. Inflation can be deadly to your investments, reducing your real asset value even when the nominal worth looks higher. For bond investors, inflation is particularly damaging. For instance, if you buy a 30-year bond with a 3% annual yield, but inflation also averages 3%, all you've done for 30 years is break even. If inflation runs 4%, then you are actually losing value. Traditionally, investors have protected against this threat with tangible assets like gold, and that's still a good idea. In fact, I currently recommend a gold ETF in my international ETF trader service. Bond traders can also mitigate the damage from inflation by using Treasury Inflation-Protected Securities, or TIPS. Unlike other Treasury bonds, TIPS have a built-in inflation adjustment feature. So, if inflation rises, you get paid the adjustment principal at maturity. In order to measure the expected inflation rate over a given time period, you can subtract the TIPS yield from the regular yield of a regular treasury with the same maturity date. This is called the TIPS spread, and it tends to rise when the bond market signals higher inflation expectations. Now, you can bet whether inflation will rise or fall using exchange-traded funds and exchange-traded notes. The PowerShares DB US Inflation ETN goes up when the market action signals higher inflation. And if deflation is considered more likely, the PowerShares DB US Deflation ETN is designed to rise. Both of these instruments are based on indexes that measure the TIPS spread at 3 different maturities: 5 years, 10 years, and 30 years. The result is a blend of the market's short, medium, and long-term inflation projections. If, like me, you're not a fan of the counterparty risk that ETNs carry, there are also ETFs that let you bet on inflation. The ProShares 30-year TIPS Treasury spread, or deflation, with the ProShares short 30-year TIPS Treasury spread. The key difference here is that these ETFs are tied strictly to the 30-year TIPS spread, rather than a mix of maturities. So they're likely to be more sensitive to short-term changes in the inflation forecast than their corresponding ETNs. Of course, these aren't the only ways to protect your investment against inflation or deflation. As I said before, gold funds and other traditional hedges can work too. But the instruments I discussed today give you a laser focus on the TIPS spread without other complicating factors. I'm Ron Rowland for Money and Markets TV. Thanks for watching.